Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, I finally did it. I opened the Adobe position. I've been kind of dancing around it. I've made videos about it. Obviously, if you guys follow me on Twitter, I've been particularly very loud about how great of an opportunity this business is. This is the lowest valuation the business has traded at. We'll get into all of those details later on in the video. I've been kind of dancing around it. I finally opened the position. We have a starter sub 2% in Adobe, and I plan on making this, north of a 10% position in the future. Again, I've done recent videos about Adobe and software in general, but I kind of want to walk everybody through what I'm thinking about valuation, all that great stuff. For starters, I want to address the elephant in the room, which is the narrative of AI killed them. And so I made this meme. Ironically, I actually made this in Canva. But I made this meme and I posted it of me on my way to buy Adobe because the last 3 AI killed them stocks went so well. By the way, just for your reference, like Salesforce, I sold that at $3.15 and rolled it into Uber at a $66 average. Obviously, Salesforce hasn't done well recently, but just kind of clear the air on that. But this has been a repeating theme in the markets since kind of ChatGPT launched is, oh my God, AI is going to come and disrupt them. And it hasn't materialized yet. We haven't seen it in the numbers. We haven't seen it in anything really except for the stocks being down over fears of like AI killing them or, autonomous vehicles in the case of like an Uber. And sure, there's a chance of like, we're kind of jumping the gun on this and like within 5 to 10 years, video generation gets so good that it makes Adobe obsolete. That is kind of the unknown and like the end state risk to all of these businesses that, again, it could very realistically happen. But I'm a large proponent of the fact that distribution matters more than any new technology that kind of comes about. Case in point for this, by the way, would be something like Microsoft. And like an excellent example for that would be their messaging app, Microsoft Teams. Obviously, Slack was like the industry leader for many, many years. They made Microsoft Teams, and that immediately took majority market share as the industry leader. Zoom and Microsoft, whatever their video conferencing equivalent of it is. Distribution ultimately matters the most. And you could even see this happening with something like AI at the moment of like, yeah, ChatGPT was the early industry leader, but you look at it now, Google with their Google brand and everything like that, the ability to kind of embed that all over the place, putting it into the AI overviews, people are, kind of shifting back their searches over to a Google because the AI overview is just as good for many, many searches. Now, of course, there's like a layer of like getting a little bit deeper into more personalized things. Google has, again, combated that with adding an AI mode, which is just Gemini on the search interface. So there's a lot of back and forth. This technology is rapidly expanding. The point I'm trying to make here is distribution ultimately matters most out of any new technology that comes out. The player with the distribution, even if they're a little bit late, they can probably figure it out. And so I say all this to say that like ultimately Adobe is the company with the most distribution within the sort of creative space. And if you look at their most recent report, they had a slide in here talking about how AI influence revenue hit like a 2 billion. Was it 2 billion or maybe it was 250 million? Yeah. Okay. This is exactly what they said. This literally the first line in the earnings report is AI influence ARR surpassing $5 billion and AI first ARR already exceeding the 250 million year-end target. I don't think they actually break out like exactly what that is. So, the numbers could be a little bit fudged, but they're, again, embedding AI features into the Creative Cloud suite of products. And so ultimately the designers are able to benefit from those products and not have to go looking for a new solution that is kind of incorporating those things. I think Firefly has done exceptionally well as well. They had some growth metrics in here of like Firefly app grew like 2x or something ridiculous. And so again, similar to the case with a Google of like, oh, ChatGPT is just going to disrupt them. Yeah, but they're responding. Like they're embedding all these AI features and LLMs and whatever into search and into their products. And ultimately the thing you guys get the idea. The thing that matters most is the distribution. Now, the second complaint that I'm going to cover, which I think has more merit to it, and we have seen it kind of impact the numbers a little bit more, is the increased creative pressures from, I shouldn't say creative pressures, but the increased pressure and competition from tiny little startups, cloud native usually. They come in the format of like apps. They're a little bit nicer UI and UX, a little bit faster, more nimble, suited for, in many cases, a less professional audience. Just increased competition in general. I think this has been like a bit of a bad narrative for Adobe, especially because they tried acquiring Figma in 2022 and they obviously failed at doing that, right? And so again, I think this narrative has a little bit more merit to it of like there's increased competition coming for Adobe's lunch. But even at that point, like you look at Figma, no, you could search this up for yourself. You could look at Reddit threads about it, of people talking about it. This is actually one of the searches here. Figma is not a direct Photoshop competitor, which is obviously one of the big revenue generators for Adobe. Instead, it was a competitor to Adobe XD, and Adobe actually literally stopped working on Adobe XD in 2023 in anticipation of we're going to get Figma and like kind of roll with that. That'll be our new product. as a UI UX design product. And obviously the acquisition didn't go through and they literally discontinued it. So the part of Adobe's cloud suite that was competing with Figma, they discontinued because they just realized they're going to lose that battle over time against Figma. That's why they kind of tried acquiring them, right? And then same thing goes for Canva. Like, I would say Canva's definitely a bigger Photoshop competitor, but even for them, like, Adobe is a lot more granular, a lot more comprehensive of a product, whereas Canva is supposed to be a little bit more simple and easy to use as opposed to a Adobe product. And then to combat the idea of like, oh, these companies are going to keep growing bigger and bigger. They're growing super fast as it is, and they're just going to eat Adobe's lunch. It's not like they're new. Like, Figma's been around. Canva has been around. They're actually, in terms of users, bigger than Adobe is currently. But of course, they're not able to monetize that as much because they have that freemium model as opposed to Adobe's subscription, right? I think Figma has like Canva has like 200 million-ish. Yeah, 200. This is as of 2023. So they're, probably north of 300 million monthly active users. That's a ridiculous amount of people using Canva. You also have CapCut, which I think they're north of like 500 million users. Okay, it's just 300 million as of 2024, and they're projected to do 1.5 billion downloads in 2024. And so this is, for super low end, like a TikTok editor or whatever, this is the stuff that they use, which doesn't make me too nervous because I don't think that person would have been an Adobe customer at any point really anyway. I don't think the person that's doing TikTok edits of Lewis Hamilton was realistically going to dish out $30 a month for an Adobe subscription. Because there's a CapCut, because it's free, that person is using it, right? And I think this is something I got from the recent Acquired episode that they were talking about Google and Google Sheets. And they were saying how Google Sheets has, the most amount of users. Like, they have 60-70% market share on a user basis, but they have like 10% market share on a revenue basis because Excel is still the gold standard that the professionals use, and the professionals are the people that are willing to dish out money for that subscription. And because it's the industry standard, they continue to dish out for that subscription, whereas like Sheets is a little bit more lower end and like is free to most users. You know what I mean? I think a similar dynamic can play here of like Adobe's the industry standard and the professionals use Adobe because it's the most comprehensive and it's been the standard for 40 years, whereas like a Canva or a Figma or whatever on users basis is going to completely dominate. But again, they're free. So like, what is the value of each user? You know what I mean? So that competitive issue, I also kind of sidestep, and like, it's not too big of a worry for me personally. I think Adobe can continue to excel at their part of the market, right? And so to kind of really tie in like everything at the end here, I want to read you a piece from the Morningstar report, which by the way, Fiscal AI provides Morningstar reports to you under the research tab. This alone like pays for your subscription. The Morningstar report is a $300 a year subscription. Fiscal AI, depending on your plan, is not that far off or cheaper in some cases. So anyways, I want to read you a section from the Morningstar report, which I think really encapsulates everything I just said. This is under the economic moat section, which by the way, the whole section is a great read, but obviously for time's sake, I'm only going to read you this bit. They say, we believe Creative Cloud, which is the entire suite of Adobe products, enjoys the widest moat under the Adobe umbrella. Like many software solutions, once Creative Cloud or any of the individual applications contained is inserted into the workflow of creative professionals, it becomes very difficult to change solutions. Further, while there is no shortage of competitive point solutions, there really isn't, there's a billion of them, Adobe Creative Cloud is so pervasive in the creative world that replacing it would be an insurmountable barrier. Replacing Adobe's products would be an insurmountable barrier. In our view, because nearly all creative professionals rely on the Creative Cloud, all other creative professionals must also use it. Again, this is the standard moat. This is, you could think of it the same thing as like a Salesforce, a same thing as an Excel. Because everybody else uses it, this is the network effect. Because everybody else uses it, we also have to kind of use it because of, file formats and all this crazy stuff. While the Creative Cloud has its issues, particularly with premium pricing, yeah, definitely, and any one organization or freelance professional might be willing to switch, they would find it difficult to work in an industry that has generally standardized around it. Similarly, Adobe's large installed base helps ensure that when the company releases or acquires related new solutions, it immediately faces a substantial and welcome audience. This is the Microsoft bundling mode. This is the fact that they're the standard of the industry, right? So it's such a powerful business. And I think because the stock is down so much, people are kind of been blindsided to just how great of a business we still have on our hands here. Yes, they're facing competitive pressures. Yes, there's a question mark around long-term AI and where that could lead. But I mean, look at it presently with the business you have in front of you. It's still the standard. There's still 37 million people that are using it every single day for graphic design and editing videos and movies and podcasts and God knows how many different use cases there is with the Adobe products, right? And they're paying, well, I shouldn't say they're paying, but their business is probably paying a substantial amount of money every single year to Adobe to be able to have that subscription for them. And if you're a marketing agency making $5,000 a month off of this one person, doing their work, are you really going to try to look to cut costs for $30 a month on their Photoshop subscription? No. That's mission critical to their business. That's how he gets his work done. It's like if you were to show up to work and not have a laptop, what are you good for, right? Like you have to have the Adobe subscription. And unfortunately, they don't necessarily break out like what percentage of users are professionals versus like lower end, somebody like me, for example, who would be, just in need of like a single point solution. They don't really break that out, which is a bit unfortunate. But I mean, judging by the numbers, right? And like we look at revenue growth for the past, I would say roughly 3 years is like relevant history since they've kind of became profitable coming out of 2021 boom and stuff like that. Post ChatGPT launch, they've been consistently growing revenues 10, 11, 12%, right? So I would assume it's like a pretty sustainable number of professionals that rely on this product, right? Again, Canva isn't something new. Most of the people that would have canceled their Adobe subscription in favor of a Canva have probably made that choice already. They've probably moved on. And it's not like, you cancel Photoshop and you move to something like 10 times cheaper. No, you cancel a $30 subscription for a $20 subscription. Is it really that big of a change? So anyways, enough about the Moat. I think, judging by what we've covered so far, hopefully I've convinced you that like, I think the Moat is still intact and we're able to kind of sustain this pace of growth in the future. I don't think the business is going to zero. I think they'll continue to grow. I mean, just purely off the back of like more seats within a company. You have a company that has 30 creative professionals. Over time, they're going to hire more people. When they hire more people, they're going to buy additional licenses under that same plan. Again, there's unfortunately no real numbers that Adobe breaks out for those type of things. I said in a recent video, like I would love if they did it like how Monday does, where it says like, users with like 5+ accounts and like the retention metrics on that. Like customers with 10+ users, customers with 5+ users. If we had that level of granularity, it would make me a lot more comfortable as a shareholder. But unfortunately, they don't break that out. But more in terms of the numbers, right? Now that we've gotten to, okay, they'll be around. Let's talk different scenarios, even like a super bear case scenario of like, okay, let's just say like they stopped growing, right? And if we said this business only grows through price increases, and they've roughly averaged globally like around a 4%-ish price increase through multiple years, right? If we said revenue grows at 4%, they've peaked their operating margins at 37%. So I'm saying literally over the next 3 years, that improves slightly, which of course there's inherent operating leverage built into the business. Obviously margins will go up over time. So that's like super bear case. I would imagine margins expand a little bit more than that. And then I say a 5% buyback. Now, at the moment, if you go over to Adobe and you toggle on the buyback yield, it's 7%. It's a 7% buyback yield. But if we do total shares outstanding reduction, which is factoring in stock-based compensation, over the trailing 12 months, they've reduced shares outstanding by 5%, assuming the valuation stays relatively the same and they dish out all of their free cash flow to buy back shares, which that's what they have done historically. I think Ryan actually posted one of those charts recently. Yeah, here we go. This is in the gray, we have free cash flow. In the red, we have repurchase of common stock. As you could see, there's been very few quarters or years where they haven't like basically matched free cash flow to repurchase of shares. And then particularly over the past, I think, what is this, like roughly 6-7 quarters or so, the red has outpaced the gray. So they've been buying back more shares than they are bringing in free cash flow into the business. They're dipping into the bank account to be able to fund that. Over the past 12 months, they've done $9.6 billion of free cash flow, $11.7 billion of repurchases, right? So the company themselves, they think the stock is cheap. Side note, the CFO of the company has been also buying shares, and I could show that to you as well. Admittedly, it's a pretty small buy, only a 1% increase in his share count, but still, always a good sign when the C-suite of the company is buying shares in the open market. They have many reasons to sell. They want to go fund their house in the Alps or save up for a skiing trip. That's a shout to the Paycom CEO. But there's only one reason that they would be buying shares into the business, and that's because they think the stock will go up. That's it. Going back to my projections with the business, right? You have 5% buyback, which is what they're currently doing. You have the 4% revenue CAGR, which again, so unbelievably pessimistic with that assumption. And then if we were to assume that it trades at the same 17 times EV to EBIT multiple, which it currently trades at, you still get a 9% CAGR on this business. So I'm saying with the worst possible growth assumptions that you can possibly think of, you're still getting market performance purely off the back of the buybacks. Now, the more likely scenario, which I think will happen over the next 3 years, is that we just maintain the same revenue cadence that they've achieved in the past. They keep growing at around 10%. Now, again, I'm not going to adjust the margins, which I disagree with. I think we should bump this up to like 39 or 40% margins. But anyways, I'm going to keep it there. And at that same valuation, you're looking at a 15% CAGR on the business. You're on pace to double your money in 5 years. But obviously I'm only doing like a 3-year outlook for this. And so I've posted this chart many times with different ratios and everything like that. But if you look at Adobe, they're currently trading at their lowest valuation, I think, since the financial crisis. I don't have any data to show you what the valuation was during the financial crisis, but obviously I would imagine it was pretty cheap even back then. But you look at the business today, it's trading at 16 times forward PE. Now, if you want to use price to free cash flow, if you want to use EV to EBIT, if you want to use enterprise value to the number of bananas that were eaten inside of the Adobe headquarters, anything you use, the stock is cheap. It's at the cheapest valuation it's been at basically ever. And I would imagine similar to the case with like Google, where it was trading at actually exactly the same. It was trading at like a 15, 16 times forward PE not that long ago. And then today you look at it, I think it's like a 20, wow, okay, it's at 26 PE. So I'm not calling for the business to trade back up there, to trade up to like a 24 times forward PE from 16. But I mean, what happens if we get like a moderate re-rating? What if this goes up from 17 times to say 20? Right? In that scenario, you're looking at north of 20% CAGR. What if it re-rates back up to like similar to like where somewhere that Google is trading at, right? Roughly call it 25 times EV to EBIT. You're looking at a 30% CAGR. So depending on the multiple here, you have room for like comfortably outperforming to like, this is literally the next Google, where you get like a 60% rally in like 2 months. And so me personally, with all the risks I outlined, combated by the fact that like they're still the standard, they're still putting up monster quarters, beating and raising and everything, every single quarter, the business has fundamentally stayed intact and it trades at the cheapest valuation it's ever traded at. You have basically no downside with all the room for the upside of like a huge rally over the next year, 2 years, whatever, with a quick narrative shift. Now, I would actually like to hold this business long term. I'm not in this for like a quick trade, hoping for that Google type rally. I would be very much in favor of like holding this at a 10% position for the long term until it gets like egregiously overvalued. But I don't know. We'll see what happens. Maybe I'll make a video 3 years from now looking at how stupid I am because Adobe is on its way to bankruptcy. But again, I really don't think that scenario plays out. Another funny thing that I'd like to note here is with the 4% scenario, right? With revenue grows at 4%, which is just price increases, you would have to go down all the way to 12 times EV to EBIT in order to lose money. Mind you, like I think a company like Lululemon, actually they're probably cheaper, but a company like Lululemon is like trading in that ballpark. Oh wow, okay. Lululemon is significantly cheaper. Okay, something like Fiserv, right? This is another company I own, which is like obviously narrower moat than an Adobe. And I would argue this company's stupidly cheap as well. But yeah, like I really don't see that scenario playing out. So your downside is you don't lose money. Your upside over the next 3 years is you get 30% per year CAGR. In like a pretty basic case, by the way, like we go to 25 times multiple with 10% revenue growth. Like it's not that crazy, you know? Anyways, thank you for watching. If you like these type of videos, I do have a Discord. If you want to come hang out with me and 270 or 280 other investors, honestly, a huge portion of me kind of convincing myself into buying Adobe. Like I was going off in the Adobe chat here. I would actually like to kind of show you a couple of the messages, but too hard to find. We'll save it for another video. Thank you for watching and have a great day.